Welcome to everyone. We are going to get started now. We're expecting a very good turnout today, and so I wanted to thank everyone for participating in the webinar. This webinar is on credit appraisal approaches and tools to help prevent loan delinquency, and it's presented by Cecilia Deacon, a development banker specializing in credit risk management for micro and SME-oriented institutions with over 30 years combined experience in mainstream banking and in MSME consultancy. Her microfinance consulting work started in 1999, and she has assisted more than 20 micro and SME-oriented financial institutions in Asia and Africa with remarkable successes in bank turnaround and in assisting startup microfinance operations. And now I would like to turn it over to our very experienced facilitator, Cecilia Deacon. Thank you so much, Cecilia.
Thank you, Jessica, and I'd like to welcome all of you once again to today's webinar. Now, as Jessica mentioned earlier, this topic on loan delinquency is a big one, so we had to split it into two parts. First, we will be talking about the steps in delinquency prevention. And in September, we will be gathering you once again to discuss together the loan delinquency management measures. So for today's session, our objective is first to look at the characteristics of loan delinquency and to know the causes or the drivers. And we need to know also at what point does loan delinquency become a serious problem, how it impacts our business, and we will also be sharing with you the loan delinquency prevention tools and techniques. Now, the biggest nightmare of a lender is dealing with delinquent borrowers, isn't it? It is so draining, and it distracts everybody from doing our day-to-day routine very well. So for lenders like you and me, loan delinquency is the enemy number one. Now at this point, I'd like to hand you over to Jessica for a very brief poll question.
Great. So we'd like to get a sense from you in terms of what is the toughest aspect in lending to small businesses. So if you'd like to go ahead and choose any one of these, we're going to wait 5 more seconds. Okay, we're going to close the poll at this point in time. And Cecilia, 100% of the people, participants said that information validation is the toughest aspect in lending to small businesses.
Great. Great. Okay. Thank you, Jessica. Okay. So at this point, let's talk about the characteristics of loan delinquency. It is very critical for us to know how to identify signs that loan delinquency is about to hit us. Now, first of all, we have to appreciate that loan delinquency is contagious. Anytime that it starts from a single loan borrower, we have to be very careful, because from a single loan officer, it spreads to the entire branch. It can contaminate another branch, and before you know it, the entire institution will be suffering from this problem. So just like a fire, at the onset, we have to arrest it right away. And secondly, the cost of delinquency are hidden. When you're just talking about 3, 4, 5 delinquent borrowers, you won't see the cost implication, especially on the bottom line of the institution. Now, you will only wake up one day and find out that you're hardly hit if central bank comes in and asks you to book huge amounts of loan loss provision. So the true level of loan delinquency can be concealed, making it difficult to recognize the true extent of the problem. And also, lenders tend to attribute delinquency excessively on external factors. And this is absolutely wrong. In fact, delinquency drivers are mostly controllable. So let's try to refresh our minds at this point on what are the loan delinquency drivers. So here we have listed about 16, although there are dozens of loan delinquency drivers. That would depend also on your circumstance, like the environment where you operate. Now, if we can go through these 16 very quickly. Now, first, we have poor client selection, lapses in loan underwriting, weakness in loan approval system, weakness in loan monitoring system, unclear policies and procedures, poor compliance culture, weakness in performance management system, weakness in control systems, absence of automated loan management reports, weakness in product development, economic downturn, fraud, changes in regulatory policies, high staff turnover, weakness in product design, and calamities. Now, out of the 16, let's try to see how many are actually controllable. So there you go. Of the 16, only 2 are uncontrollable. The changes in regulatory policies and calamities. So now I hope that at this point, we are all convinced that controlling loan delinquency is actually in our hands. Now, what are the impacts of loan delinquency? There are 2 major impacts that we need to discuss about. And these are the financial and non-financial impacts. Now, financially, loan delinquency will kill your profitability, will decrease liquidity, and increase operating cost. Now, if one borrower stops paying on time, your liquidity will be affected. Now, if you have 20, 40, 50, 100 borrowers that are not paying on time, you won't be able to disburse more loans to those who are also needing financial assistance. Now, following up delinquent borrowers increases your operating cost. The transportation costs of our loan officers, communication costs, and also their time, and even management's time in pushing for loan recovery. On the non-financial aspect, breakdown of credit discipline among clients and staffs is very serious. Can you imagine if discipline breaks down internally within the institution, then immediately that will affect also the behavior of your clients. And because of so much pressure to recover the loans, ROs, LOs will be pushed left and right for targets and also for loan recovery. And in many cases, they get so burned out and they just leave the institution. An increase in staff turnover will mean high cost to the bank because you have to hire new employees, you have to spend on training so that they can take over the portfolio. The third point also is its impact on the reputation of the institution. Reputational risk will eventually lead to reduced access to fund sources. Now your funder institutions will hear through word of mouth that this institution has very high cases of delinquency. And it is pretty very, very unpleasant to think for a bank to consider that 1, 2, or 3 of your funders will start closing down your credit lines. So your sources of funds will get fewer and fewer as you are getting unable to recover the loans that you give out. Now, this slide summarizes the negative impact of loan delinquency. As we said earlier, first of all, it increases our operational expenses and decreases operational income. So, how does it increase operational expenses? Now, we have to intensify collection effort, and it will eat up a lot of our loan officers' time and also management time, doing portfolio analysis, and also the cost of litigation. Now, our lawyers won't move for free. We have to pay them good money. So that eats up now our operating income. Now, if most of our loans don't move and giving new loans now slows down, our interest income will also decrease. And portfolio turnover means, slowdown in portfolio turnover means lesser interest and fees income. And it will also curtail our lending expansion. Now, at this point, we will ask you one brief question again, and I'll hand you over to Jessica for this.
The question is, when does your institution consider a loan delinquent? And so we're looking at this in terms of your loan monitoring process. We're just going to take about 10 more seconds here, and we're getting pretty spread out answers here, Cecilia. So there's not a clear winner in terms of what is a delinquent loan. So we'll go ahead and close it now, and we're seeing about 40% saying 1 day delay, 40% saying 30 days past due, and 20% saying 90 days past due. So Cecilia, maybe you can share a little bit in terms of best practices in some of your upcoming slides as well.
Yeah. Okay, thank you, Jessica. Okay, so now let's discuss about some of the ways that an institution can lessen the impact of loan delinquency. Now, first and foremost, it is very important for us to institutionalize the following. First, strong preventive measures. Second, the mechanism for early delinquency detection, so that we will be able to identify and resolve to pursue collection immediately. Now, slide number 6 tells us that almost all of the drivers of loan delinquency are under our control. And slide number 7 tells us how delinquency can doubly hurt an institution, financially and non-financially. Now, picking it up from there, let us now discuss how an institution can control the impacts of loan delinquency. Just like a serious illness, there are 3 key things that we must keep in mind. First is to institutionalize strong preventive measures. Now, nobody wants to get sick, so it is very important that we avoid all chances of exposing ourselves to health risks. Now, in lending, we also have to be aware in the first place what are the means to prevent our institution from being hit by loan delinquency problems. Now, secondly, we have to put in place a strong mechanism for early detection in case 1 or 2 of our loan officers get hit by delinquency problem. It is critical for management to have tools and mechanisms to detect the very, very small signs of the delinquency problem as soon as possible. Now, thirdly, it is important also to find ways to resolve the problem immediately. It's not enough for us to be able to detect the problem at an early stage. The most important is for us to be able to drive everybody to start running right away the moment that we see one or two loans starting to fail to pay on installment due date. So once again, we have to start running to pursue collection on day 1, not day 30, not day 60, not day 90. Okay? So at this point, we have one more question, and I'll hand you over to Jessica to explain the full question.
At what stage in the lending process should delinquency prevention start? And so we're going to take just about 10 more seconds here. And again, we're getting a pretty wide variety of answers. So if we want to go ahead and close the poll, David, so 65% are saying during the client selection phase, 25% during loan appraisal, 5% during collection, and 5% during none of the above. So Cecilia, maybe you want to just share the correct answer with us so we know what are the best practices for delinquency.
Yeah. Delinquency prevention starts from the day that you select your clients. Now, one of the critical policies that our institution must put in place is the client eligibility criteria. Now, loan officers must be very careful in choosing customers. Now, be very aware that there are customers who are in desperate need of money, maybe because they don't have any other institutions to run to. Now, at client selection stage, you must stick to the client eligibility criteria, plus you have to trust your gut feel. I have been a loan officer before, and I really trust my gut feeling. I have encountered so many loan applicants who I feel very uncomfortable dealing with at the first meeting. So please, if you have that kind of feeling, you have to share right away. So at that very stage, you have to think about the reason why you have to be very sensitive, and it's all about preventing your institution from getting exposed to loan delinquency problems. Some of delinquency preventive measures. There are 3 key stages in the loan process flow where you have to strongly screen your applicants, and you have to execute properly the steps in order to prevent your portfolio quality. Now, first is the loan underwriting stage. Second is loan documentation. And third is monitoring. Now, at the loan underwriting stage, this is where this starts actually during client selection. So you have to ask yourselves many times, is he or she the right customer? And you have to do a thorough information gathering. Remember, there are dozens of questions that you ask yourself about the borrower and the business before you proceed your loan appraisal process. Now, if you are satisfied based on the information that you gather that this is one customer who would you like to do business with, then that's a time that you proceed and do your loan appraisal, do the cash flow analysis, and review the background checking results, the CRB report, and then ask yourself again so many times as you read through the cash flow analysis, how much cash comes into the business and when is it coming? Two very critical aspects, not just the amount of cash, but the timing as well. Now, how much cash flows out of the business and when? For example, if a customer has a lot of cash coming only once every quarter, you have to be very careful now in structuring your loan repayment, because it is very clear in the cash flow analysis that in between the quarter, the customer won't have any money to pay your loan. Now, another thing that we need to look at in the cash flow analysis is the amount of money that the customer needs to draw from the business for personal use. We have to understand that our target customers, the small businesses, do not separate their money for the household and the business. So it is our task as loan officers, as approvers, to make sure that money that is allocated for personal use is properly accounted for in the loan appraisal. Now, let us look at another aspect in loan underwriting that is very, very important in terms of preventing our institution from loan delinquency problem. Now, it is about proper loan structuring. Now, when we talk about proper loan structuring, we start from asking ourselves, what type of loan should I give the customer? How much should it be? What security should I require? What conditions do we have to set? How do we go about the disbursement? Shall we give the money all at the same time, or shall we disburse it in tranches? And also the structuring of the loan repayment. Now, what should be the basis in determining the amount of the loan to give? Should it be the value of the security or the borrower's ability to pay? Now, using the value of security to determine how much loan to give the customer is the most convenient but the most dangerous approach. The ability to repay the loan should determine how much loan a borrower can get. And this is the essence of cash flow-based lending. Now, does it mean that you don't bother about security anymore? Of course not. You have to require security, but just as a second fallback when something unexpected happens to the business. Now, what about conditions? Sometimes approvers feel that there's a little bit of a risk that needs to be covered extraordinarily in this account. So even if cash flow, the net cash flow shows that the business can repay the loan, the approvers may require additional security or any form of guarantees. Now, sometimes loan officers get affected if after all the loan analysis that they've done, it's very clear that the customer can pay and the timing is properly accounted for and taken into consideration in structuring. Now, credit committee sits down and says, for this account, can we ask for additional security? Now, let us keep in mind that the reason for doing that is just to tighten the security coverage and to prevent the institution from getting hit by loan delinquency problems in the future. Now, the mode of disbursement, why is it critical? Different businesses have different dynamics, and the dynamics would also determine the timing for you to disburse the loan. A construction project, for example, money is needed to buy materials or to pay wages. Now, it is not best practice to disburse the whole amount of the loan at one time. Perhaps this time, the customer needs to buy materials, but not to pay wages. So, in your analysis, you should have a very clear indication. Which period does the customer need money for purchase of construction materials, and at what period does he need the money to pay wages, for example? So, disbursing the money now should also be in tranches according to what is needed at any given point. Now, structuring the loan repayment is also critical. As I mentioned earlier, if you are dealing with a business that only generates cash once in every quarter, like schools, for example, this is a very typical example. Now, how would you structure repayment? Should you structure it in like monthly, equal monthly installments? Now, you might have problems during the 2 months where the school does not collect school fees. In most cases, school fees are paid at the start of the term. So in this kind of business, it is very typical to do like a balloon payment for every quarter, and in between, in most cases, they just require the customer to pay interest. Okay? Now, another aspect in preventing delinquency is using very, very basic, very simple tools and forms. Now, first we have the application form. How can the application form help us prevent delinquency? Now, what do you find in the application form? The application form captures personal and business information. So personal information that impact your assessment, your loan appraisal, like the number of dependents, the information related to the standard of living, for example, the location of the residence. Do they live in high-end estates, or do they live in very humble, very humble areas? The type of school where their children study, are they in exclusive schools or in public schools? That will also impact the volume of cash that the family is using from the business. And also, in doing the client interview, it is very important that our loan officers use a guide. They have to make sure that they ask the most important questions right from the first visit. It is very irritating for customers if after the interview, after the meeting, the loan officer starts calling them again because they have forgotten to ask 1 or 2 questions that would impact their loan appraisal. So if we can give them a very simple guide, I have seen institutions that have in their policy and procedures manual a list of all the questions that loan officers must ask during the interview. And the historical cash flow report is also important because it will walk you through the trend of the cash inflows and outflows in the last 6 or 12 months. And then as you finish analyzing the historical cash flow, then we can go ahead and prepare the projected cash flow report. Now, in the projected cash flow report, it is critical for us to add the installment that the customer has to pay us periodically. And in addition, the summary of the loan request has to be clearly written. We have to keep in mind that the approvers who review the loan proposal does not have any idea of how the business operates on ground. So we have to require our loan officers to make the loan proposal very, very clear. The proposal should walk the approvers through the dynamics of the business, how the client operates, what are the peaks and lows, the seasonality of the business. Otherwise, the committee cannot come up with a well-informed decision if some of these key aspects are missing. Now, loan documentation. This is also another critical preventive measure to loan delinquency. What happens if there are errors in a loan contract, for example? I have seen many institutions losing money because of errors in typing loan conditions, loan terms, and even loan amount in some cases. Now, these errors weakens your position to enforce the content of the covenant, especially if you're faced with the worst case scenario now. If you need to liquidate security, for example, if there are errors in the description and in the terms and condition, then you will be in a very disadvantaged position. So accuracy and completeness is very critical in preventing your institution from having delinquency problems. Now, what about monitoring? This is one aspect that is often neglected. It is very common for loan officers to be just happy giving the money because now they can hit their targets, and they start running again looking for other customers. We must not fall into that mistake. The fact is, monitoring is a very strong preventive measure. Now, let us understand, why do we need to monitor? Whose task is it to monitor? When to monitor? What to look for when monitoring? What tools you need in monitoring, and how to handle monitoring these observations. Now, the first period for loan officers to monitor is 1 or 2 weeks after you gave out the money. It is very important to validate how the money that you gave is being utilized by the customer. Is the money used for the purpose intended, or maybe the money is diverted? So this is the first critical point, and then moving forward, monitoring will give us now an idea of how the business operates given the given the additional infusion of capital that was given by your institution. Now, in the course of monitoring, there could be some adverse observations, and those have to be documented and escalated to higher management if needed. Now, what are the monitoring tools that your loan officers must use? First, you have to have simple but clear loan monitoring reports. The loan officer must have a monitoring template. It doesn't have to be complicated, very simple ones, but having all the necessary information that should be contained in their loan, in the credit files. Now, the form should also provide for steps in escalation of issues now. If there are observations, for example, that the loan officer needs to discuss with the supervisor or the branch manager, there should be a space in the form that will guide them how to go about escalation of issues. Now, let's look at some of the best practices in measuring delinquency. There are 2 formulas that we can use. First is getting the percentage of installment in arrears, And another ratio is the portfolio at risk ratio. Now, different institutions use different ratios. But we have to understand at this point, are these two measures the same? Do they tell you the same type of information? Do they tell you the same, what you call this level of alert? And which do you think of the two measures complies with the best practice? The best practice tells us that using portfolio at risk ratio is very, very effective. If you look at the formula in computing portfolio at risk ratio, you don't only look at the amount that the customer has not paid, but the remaining amount of the loan that the customer is supposed to pay. Now, if he or she misses one installment, we have to keep in mind that the entire balance of the portfolio is already at risk. And this is the message that we get when we use the portfolio at risk ratio. Now, another important aspect in preventing loan delinquency is to regularly review and analyze the status of your loan portfolio. Now, in the course of the analysis, you will be guided to categorize your borrowers now. If you have the loan aging report from your system, that will guide you. You can have so many ways of doing cross-analysis. You can analyze your portfolio at risk in terms of the contribution of every loan officer or the contribution of every branch or even the geographic location of your branches. You'll find out that if you do this type of cross-analysis, you will be given an information more or less on the likelihood of getting delinquent borrowers in some of the geographic locations and even in the profiling of the branches now. That will also lead you in appraising your performance, how every branch is performing from the categorization that you get. Now, client incentive is also one good way of preventing loan delinquency. Sorry. Incentivizing borrowers is not very costly, but it can boost their morale in many ways. Now, what are the examples of client incentives that many institutions give? Many of the institutions give very simple tokens like pens, umbrellas, t-shirt, small tokens like purse. Now, these seem very simple, but in my experience, our clients feel important if after completing one loan cycle, for example, the loan officer hands them a very simple token. Now, if we can give them some small rebate on the charges and fees for the next loan cycle, they will be happier. Now, what is critical, though, is for us to determine what those small incentives would mean to our bottom line, how much they cost, and what is the cost benefit that we get out from this one. Okay? So, in closing, let us bear in mind two very important things. First is that loan delinquency is mostly caused by internal factors. Let's keep in mind what we saw on slide number 6. And second is the fact that loan delinquency can be prevented. They can be prevented. It's true that we are exposed to this problem every day. But as we have discussed earlier, there are many ways that we can prevent our institution from this type of problem. And finally, let me just share with you this very important lesson that I have learned in my many years of doing this practice. Now, the image and philosophy of the bank determines if it will experience high or low delinquency, and the way your borrowers perceive your bank determines how seriously they consider paying off their loans. So with this, I end my presentation, and I'll hand you over to Jessica for more questions.
Well, now we've moved into the discussion session, and we have about 15 minutes for the discussion session. So if the participants would like to go ahead and type in any questions that you have into the chat box, we'd be happy to take any questions at this point in time. And we are getting a few questions coming in, and we specifically had a question in terms of loan restructuring. And I know, Cecilia, that you will speak more about this, but in terms of loan restructuring, is there a need to have a new promissory note or a restructured agreement, or is a restructured agreement sufficient to support the loan structuring?
About loan restructuring, actually this is one topic that we will cover in the next, the second part of this webinar, but let me answer it now just the same. Now, if you restructure a loan, you will be changing the profile of the account. Loan restructuring can be done to either extend the term or to lessen the installment amounts, or maybe to adjust the period of the installments. So in this case, since these are very basic elements in the loan contract, you have to prepare a new promissory note that contains all the parameters of the obligation now.
That sounds good, and we look forward to hearing more about that in the follow-up session. We have another question that's come in, and one of our attendees is wondering, what steps should an institution take in recovering loans that have already become delinquent?
Now, this is again another topic that we will discuss in the second part, but let me answer it just the same. Now, there are many ways that an institution can recover a loan even if it has already turned bad. Now, there are so many options. First and foremost, you have to look at what securities you have at hand. That is your first way, the second way out. Now, if you feel that liquidation of the securities won't be able to cover the amount that the client owes you, if you have a guarantor or a third party who can provide additional, who has given additional security, then by all means you have to call the guarantee right away. Now, last and very long process, of course, is going through the court. Now, many institutions would like to avoid that because that would mean spending good money to run after bad money. But we are duty bound to recover the money just the same. So we will reach a point when we have no other option but just to go through the long and arduous path of recovering the money, which is going to the court.
Great. That is very, very helpful. Can you hear me okay, David and Cecilia?
Yes, I can.
Great. Wonderful. And another question, if possible, can you differentiate between loan delinquency, so a delinquent loan, and a non-performing loan?
Okay. Now, differentiation of these two is usually determined by regulations. For example, different central banks have their prescribed ways of classifying bad loans. Now, best practice tells us that you classify a loan as delinquent on the first day of missed installment. Now, in most of the institutions that I have handled, they classify loans as non-performing after 90 days, according to their central bank circular. So, and then it's very common actually. I have not seen yet a central bank regulation that classifies loans as non-performing beyond 180 days, for example. Most of the time, it's beyond 90 days. So if a loan does not get paid after 90 days, they are classified as non-performing.
That's very helpful. I think one of the most critical pieces that you discussed, and maybe the most neglected, is the loan monitoring. And so maybe you can talk a little bit more about some of the best practices with loan monitoring. There seem to be some discrepancies in terms of actually saying that a loan is delinquent from day one. So maybe you can provide a little bit more about the sort of best practices around that as well.
Okay, thanks. Now, first of all, it is important for us to keep in mind that there are two phases in a loan life cycle where loan delinquency can be prevented. Of course, before you disburse the money, you have all these steps to prevent loan delinquency. Now, after you've given the money, you can still prevent loan delinquency. And the only way for you to prevent it is by doing monitoring very religiously. Now, can you imagine if after giving the money, the loan officer does not visit until the client fails to pay? So your loan officer won't have the opportunity to see how the money is helping the business. Now, most importantly, it is on the post-disbursement monitoring phase where the loan officer builds information about the business in preparation for the next loan availment of the customer. So, two things. First, loan monitoring helps prevent delinquency for the existing loan. And secondly, the information that the loan officer gathers in the course of monitoring are very critical in evaluating now the next loan application from the borrower.
Great, very helpful. We're getting in a few more questions, and some of these, we are seeing in terms of some sample loan assessment and monitoring tools. And so, Cecilia, I think that would be a great question to put some information under our LinkedIn group for discussion, and so we can post some tools and some pieces there, but maybe you want to speak to that very, very briefly, and then we can share some of our SBBN tools to the group after the webinar as well.
Okay, thank you. Now, one of the monitoring tools that I find very critical is the expected repayment report. Now, loan officers need to be very proactive. Now, providing them with the expected repayment report will help them to identify which accounts are falling due maybe in the next 7 days, the next 15 days. Some would even want to know what accounts are falling due next month. So if you have that report, the loan officers can immediately plan out reminding their customers. For example, 1 week before installment falls due, then they can start calling the customer and in a very friendly manner just remind the customer that on this date we will be expecting your payment. Now, if that report is missing, it would be very difficult for the loan officer now to act proactively proactively in reminding the customer. So that to me is a very, very important tool that management should put in place.
Great. We're actually going to unmute one of our participants now. Nizar, can you hear us okay? I'm going to let you go ahead and ask your question directly to Cecilia. Thanks for participating.
Okay. Hi, Cecilia, and hi all there. So I'm Nizar Haneshia, Head of Corporate Banking at ABC Tunisia. Let me say first that the material provided and the information are excellent. For banks like the one in which I work, I mean, which is aware of the of those all rules and so on, we give importance to compliance, to selection of customers and so on. As a head of corporate, and this may be generalized to other colleagues in other banks or countries, the problem is that we get hurt with respect to the business development. I mean, especially when the first step in preventing delinquency, as you stated, is the selection of customers. In fact, this selection, the result, let's say, of this selection depends on the country. In a country like ours, maybe this selection will prevent me from working with a big portion of the SMEs, let's say, in the country, because SMEs, we know their reality, and even their reality differs from country to another. In Tunisia, let's say, maybe 8%, 80% of those SMEs, if I make a selection, they will be out. So this will be penalizing me in terms of business development, and that's the question. I mean, the very tough alignment of business with risk, though we know how to mitigate the risk and we know the rules. Let's say, okay. So it's a matter of rules to be known. That's done. Let's say, but put that into production and generate money and achieve targets and I mean achieve budgets and so on. That's the let's say the hard task in that. So it's not it's not a question, direct question. It's rather than I mean sharing thoughts. So that what do you think about this? Do you know other experiences in other countries? That's what I wanted to say.
Okay, thank you very much, Nizar, and I fully appreciate your concern. Now, in such situations, it is very critical for management when formulating the eligibility criteria for customers, for example, to consider the local environment. Like in highly agricultural areas, for example, the cutoff in the age for clients to qualify for a loan is usually much longer because they argue that people in the farming areas tend to have a longer and healthier life, for example. So the point that I'd like to drive at is let us make sure that our eligibility criteria won't discriminate so many customers. What is important is for us to make sure that our eligibility criteria will prevent us, the institution, from getting undesirable customers. That's the main point. Just trying to avoid undesirable loan applicants.
Thanks, Nizar. I hope that answered your question there. And it looks like we have quite a few questions in terms of loan restructuring, and I do want to make sure that we answer those, but I know that that's part of what Cecilia will be responding to in terms of the next presentation. So we will take all of those questions and provide those to Cecilia for our next webinar in September. So we hope you can all join us there. So if there's other questions that you didn't get answered today, please feel free. We're just going to take questions for about 2 more minutes, so please feel free to send in any more questions during this session now. And it looks like there was a question in terms of some of the information that you provided on PAR in portfolio management today. And so I'm not sure which specific slide that was, Cecilia, but if you could possibly repeat the information if you know where it is quickly, as well as expand upon some of the information that you spoke in terms of the PAR and portfolio management. That would be helpful for a couple of our participants today.
Okay, let me pull up slide number 23 again. Now, in this slide, we shared with you two of the common ratios that we use in measuring the loan delinquency. And for the portfolio at risk ratio, the information that we need are, first of all, the amount of the amount of the outstanding balances of the loans that had missed one installment. For example, if a loan of $1,000 have missed one installment of, let's say, 800 or 200, what we use here as the numerator is not the 200 that was missed, but the 1,000 that is remaining, outstanding in our books. Okay? Now for the first formula, if we are to compute the installment in arrears ratio, the numerator that we use is just the 200, like the amount of installment that was missed, not the outstanding balance of the loan. So in terms of being conservative, portfolio at risk ratio is more conservative because it does not only show us the extent of delinquency in terms of the installment amount missed, but its impact on the remaining balance of the loan in our loan book. Okay, I hope that answered the question.
Great. That's wonderful. Well, thank you so much, Cecilia. I think you've answered all of the questions. As I mentioned, we had a couple questions in terms of loan restructuring, which we will share with you in terms of planning for the next session, and also we will respond to the question about some tools. SBBN does have a knowledge bank online, which is available to all of our members, so you're able to access a lot of these tools by logging in to our website, and so we'll share some of these with the group and also address some of the loan restructuring questions in our follow-up webinar on this. And I'd also like to invite a lot of our French-speaking participants today to our very first French language webinar on credit risk for SMEs on October 9th. So we hope you will join us at some of our upcoming webinars, and we'd like to thank everyone for your participation today. So thank you very much for joining us, and thank you to Cecilia for an excellent presentation.